the exposure to the stock market is the highest that I've ever seen it. And it is extraordinarily high for people over 65. For people over 60, 65, they have about 2/3 of their exposure of financial assets to the stock market. And that tells me that everybody, including that boomer group, are very, very complacent, as if nothing, they don't realize they're in a risk asset. The stock market's a risk asset. Anything that rubs the wrong way on that stuff, and you're going to have some serious problems for that group because they're just too exposed.
The next quarter may see major changes in the investment landscape, perhaps more volatility as our country is seeing 2 wars and a presidential election and changing shifts in economic data as well. Ted Oakley is here to break down what is happening next in the next quarter. He is the founder of Oxbow Advisors. Always good to see you, Ted. Welcome back.
You bet, David. Good to see you again.
In your recent presentation, you talked about recent economic trends and what could happen after a Fed pivot. We'll talk about that, to the stock markets and what economic and investment shifts are happening next quarter. Let's start with some recent economic data first. So the retail sales came in on the 17th of October, and it beat expectations. Retail sales in the U.S. rose by 0.4% last month after an unrevised 0.1% gain in August. Economists had expected 0.3% growth. The dollar actually moved up on that news. Also, yesterday, the ECB announced a rate cut, but I think the dollar moved more on retail sales than the ECB rate cut. Take a look at my screen, though. If you look here, the NFIB Small Business Uncertainty Index has spiked up to new all-time highs. And a lot of that has to do with the fact that small businesses polled are still concerned about inflation, perhaps slow down the economy. So we're getting just a difference in data here. On the one hand, consumers look like, and I'll talk about consumers with you in just a minute, but consumers look like they're spending money. Consumption is strong and the economy is doing all right. But on the other hand, small businesses, at least polled by the NFIB, are not feeling so good. In fact, the uncertainty is at all-time highs. Why is that? Why this divergence here?
Well, I think one of the things you get into, by the way, as you come back to school in September and October, you get a little pickup in retail sales anyway, just from that. And I think one of the things that's happening, though, in the small business world, and I talked to quite a few of those people, is that their costs have gone up, okay? Their prices they're having to pay labor has gone up, but yet they can't push it out. They say, if I push those prices on out to the public, my business will go down. So they're sort of stuck in the middle on this thing. And then they worry a bit about, because they don't really know from the standpoint of which way the country goes and what happens in all these elections. I think that throws them a little bit. But generally, they're getting squeezed. And I think that's why they have the outlook they have.
You have a chart that shows that for consumers, the annual percent change in non-mortgage debt has grown tremendously more than their mortgage debt in the last couple of years. And that makes sense because for most Americans who own homes, their mortgages haven't changed much because they're on a fixed 30-year. But why the huge change in non-mortgage debt, Ted, and what is that going to do to consumption?
Well, I think they've continued to borrow, David, to make ends meet and to buy what they want to buy. And we haven't gone through a period yet where people will say, I just can't do that anymore. But if you look at the number of delinquent credit card accounts that have been closed, in other words, we're not going to give you any more credit, okay? That's gone up quite a bit. And so you're seeing what's happening is people are they've gone out and borrowed more to live and to do the things they want to do instead of trying to really live within their means and cut back. Because it's a tough time out there right now. I think a lot of them are having to borrow just to do the normal rate of business week to week. And that's why it's going up, in my opinion.
Well, we don't have data to prove this, but do you suspect that a lot of the retail sales numbers that have gone up, perhaps those were driven up by credit spending?
Oh, I think so. Yeah, I think so. You look at it, and I don't think they're paying for cash. For sure. I mean, even if they're using a credit card, they're not paying it off.
Yeah.
The credit card rates now, believe it or not, I mean, there's a lot of them out there now, 28.9, 29.1. I've seen a number of them like that. And if you think about that, it's just that is an egregious amount to charge to the people.
Do you think that consumer spending and general retail sales strength will continue into Christmas and into next year?
Oh, I would guess into Christmas, David, only because I think people will do whatever they have to do so that they can, buy what they want to buy for the little ones and the big ones and everybody else in the family. They'll say, hey, we'll cut back next year. But I think going into Christmas, typically they just, they say, hey, we'll do whatever it takes.
So small businesses still have a relatively large window of opportunity before perhaps things slow down for them.
They have some, depending, it depends on the business though. If you look at a lot of these small businesses that have like car washes and places where there are little food outlets and things like that, that won't affect their business, but it would probably affect the people that are selling some product, but it wouldn't be overall, I don't think.
In your presentation, let's talk about the Fed now. In your presentation, by the way, I encourage people to check out Oxbow Advisors YouTube channel, link down below. But in your presentation from 2 weeks ago, you highlighted how stock markets have performed in the past following a Fed pivot. Before we get to that chart, though, you asked a question, which is whether or not the Fed is making a mistake. And so I'm going to pose the same question you asked to yourself. Has the Fed made a mistake?
Well, they made a mistake, but they always make a mistake. That's nothing new. I mean, if you go back over 30 years, 25 years particularly, but 30 years really from Greenspan on, I mean, they do nothing but make mistakes. And so all you have to do is go back and look at transitory inflation, and then they thought that wasn't going to last, and they raised the rates too much, and now they haven't lowered them fast enough. And yeah, and now I think what they'll have to do, because the government has so much debt, is have to lower them lower than they think, which is going to create another inflationary spiral. So they're between a rock and a hard place, and I don't think they have the skill set to know what to do with that.
Are you liking this video so far? Well, video creation is challenging. So let me tell you about today's sponsor, InVideo, which is changing the game for video creators like me. And if you're a content creator, then listen up. I know that creating videos can be complex, but InVideo AI V3 changes that. With new generative capabilities, you can now create full-length, publish-ready videos from scratch using simple text prompts. Whether you're telling a story, explaining complex topics, or creating product ads, InVideo AI V3 puts you in control, bringing your ideas to life in minutes. Unlike tools like Sora and Runway that only generate clips, InVideo V3 creates entire videos ready for use, and the best part, it's launching in just a few weeks. With the edit command box, you can make real-time adjustments to your videos, plus voice cloning now lets you replicate your voice for narration. If you haven't checked out their current version, scan the QR code here or use the link in the description down below to try it for free. Paid plans start at $20 a month, so use my code to get 2 times video credits in your first month. Get started today. You highlighted that a lot of fund managers are bullish on the stock markets right now precisely because the Fed has cut rates and will continue to cut rates into next year. You also have a chart that's pretty interesting. You're showing the Dow Jones Industrial Average performance from 1914 to the present day. And apparently, according to your research here, anytime the Fed has cut rates into an environment when stocks have gone down by more than 10%, the gain in the subsequent 12 months is around 30%. However, if they're cutting into an already bullish environment, anytime when the previous gains in the last 12 months, or 24 months rather, have been about 10% or greater, then the next 12 months are looking at is usually around 2.6% of gains. So significantly less already. So basically what you're trying to say is investors are a little bit too bullish right now on the Fed?
Well, David, I think they think that, hey, the Fed's going to come to the rescue here. Rates are going to go down. We're going to go back. Happy days are here again, like I said in my newsletter. And I think they're forgetting that, you're in a period now, and this doesn't make sense, by the way, for the Fed to be too aggressive on the downside when you're running huge deficits, at a time when the economy's really doing okay. And so I think I don't know if that was political or where they were coming from particularly, but I think one of the problems they'll run into is if you start showing 3 or 4 months of inflation here, and they've already told the world, hey, we're going to move the rates down, and then they're stuck. See, they're like, okay, no, we're not going to do that. Then you send, again, after many other times they've done this, you send the wrong message to the people out there. And so, they've gone out and bought long bonds, and then all of a sudden they may not work.
The Fed cutting rates, how is that going to improve and or change, or perhaps even lower liquidity? I mean, the liquidity profile of the markets, capital markets. Would you expect that to change considerably following the last 50 basis point cut and into next year?
Well, I think, David, the thing about the Fed is their job is to really make sure, and I know it's inflation and employment, but one of their jobs is make sure the Treasury makes it. And the Treasury's been basically doing nothing but T-bills because they know that's where they can get the financing right now because so many hedge funds and short-term people will buy the T-bill when they won't buy a long bond. That's why we have all this T-bill issuance that's going on. And the Fed itself, the problem for them is they realize that this debt load we have right now is drowning the government.
Mm.
So they have two choices. They can either decide to keep the rates high and make things go austere, which the economy would break, and here they would come with low rates again, which wouldn't work. Or they can lower the rates lower than the inflation rate, which would happen, and then all of a sudden you're into stagflation, which is the way we think they will go. No, it may not necessarily go back to the lows, but you could see them run 3% Fed funds rate or something, and inflation be at 4.5. And that's the way I think they get out of the mix. But it takes a lot of years to do that.
Speaking of debt, I interviewed Philip Swagel, the director of the Congressional Budget Office. The CBO is projecting the debt level to reach 122% of GDP by 2034, the deficit level to rise considerably from current levels as well, up to 6.9% of GDP by 2034. I believe was their projection. And I actually did ask him this question, whether or not the Fed is going to lower rates because of these higher deficit levels. His answer was that,
look, there is that interaction, as you say, that high interest rates have a effect on the fiscal side, on the cost of borrowing, and that feeds back into deficits. On the other hand, monetary policy has, goals and statute, and that's, the labor market and the economy.
but what you're saying, you're looking at a 3% Fed funds rate going into the future. Are you expecting then cheap money to come back?
Well, what I'm saying is no matter where the rates are, they're going to be, I suspect, that they'll be lower than the rate of inflation. And so what would happen is it wouldn't make any difference if they were cheap because, yeah, you could have cheap rates, but your inflation's killing you on the other side. And I think what people don't realize is that if you look, for example, debt this year, the cost, just the interest on the debt this year is more than we're spending on defense. Well, somewhere in here, you have to say, okay, we've got to take care of these people that are using all this money in deficit spending. And so I suspect that's what's going to happen. It won't be good, by the way. I mean, if you're pushing the rates down and inflation doesn't come down with it. Now, maybe it does for a while,
Yeah.
but in the long run, I don't think it does.
In your theoretical scenario, you said 3% Fed funds rate and 4% inflation. Are you expecting inflation to come back?
I would expect because they keep pushing money in the system. And every time they do to try to get the rates down. But see, we're at a point now, and it's critical. You're such a point now. It's not like it was, before when you were maybe running at 40%, debt to GDP. Your numbers now are so high that when you run that number through, that it creates a quicker turn of inflation coming out of it. So that's why we felt like this next decade would be a decade, where commodities and things like that would probably would fit more. You'll own other things too, but I think people have to realize that you've got to have some sort of hedge against it.
You also have a chart showing the equities sector as a percentage of total household allocation. It's now at 57%. According to your chart, the last time it was this high was a dot-com bubble in 2000. What does this chart indicate to you?
Well, I have another one actually that's updated that shows if you take that it's up even higher than the 57. I'm talking about in the last 2 weeks. And it indicates that if you look at it now, right now, with what the numbers I have, the exposure to the stock market is as a percentage of financial assets for everybody that invests is the highest that I've ever seen it and the numbers I ever have. I don't have a number this high before. And it is extraordinarily high for people over 65. For people over 60, 65, they have about two-thirds of their exposure of financial assets to the stock market. And that tells me that everybody, including that boomer group, are very, very complacent as if nothing, they don't realize they're in a risk asset. The stock market's a risk asset. They don't realize they're in that. And I think anything that rubs the wrong way on that stuff, and you're going to have some serious problems for that group because they're just too exposed.
Okay, so usually in the past, when everybody's piled into stocks, is that a bearish signal?
It is. Because what happens is they've all bought all the way and they have no, everybody's in. And so, the cash levels, if you look at cash levels, they're low too. And bond levels are really low. But they've decided that, nothing will happen. We have short memories. So let's just put everything in. We just keep on buying. And that's the way it goes. I mentioned the other day, it's like you're a football team and you're ready to score an extra point and you decide to go for two and there's only 3 seconds left. Well, that's what you're doing right now. And a lot of them are going for two. And a lot of times you don't make it and you lose the game. And I think that's where we are right now. They're assuming that everything's going to be okay, not realizing that, if it goes against you here, it may not be so great.
I think your chart showing the historical performance of stocks after a Fed pivot is pretty crucial for investors to understand. I'll put it up on the screen one more time. So let's look ahead at the next quarter, Ted. We have a lot of things going on right now, as you've indicated in your presentation. There's a presidential election coming up in a couple weeks. There's two major conflicts in the world happening right now, one in the Eastern Europe and one in the Middle East. Stock markets continue to hit new all-time highs. The Fed has pivoted along with other central banks for the first time in many years. Central banks are pivoting and inflation has come down from its highs. What are the major shifts in the investment landscape then that will correspond with all these major tectonic plates shifting around that I just mentioned?
Well, I think the biggest one is if all of these countries decide, and it looks like they are, starting with China, and then they've just now had the ECB. Everybody decides we're going to lower rates and we're going to really get this thing going. Well, it's already going because they're all running deficits already. So for them to decide that, hey, we're going to try to juice the system now, it's not time for that. And what that will mean is that real assets will probably be the place where it will catch that on the upside. I think financial assets, people don't realize this, but when you go into inflationary times, and you may not eventually, the first 6 or 8 months, you may have rates go really low because we get in trouble here. You could, but I'm just saying eventually they come back. And we're at a time when you get debt levels this high, that means you don't have any room to move. You can't maneuver anything. And that's where we are as a country right now. We're not going to go austere. You can bet on that. So the only way for them to come through it or get out of it is really keep the rates lower, which means you're probably going to need some real assets along with those financial assets.
You're talking about commodities. Let's talk about real assets first. Commodities, real estate, gold, that kind of thing.
Well, real estate's certainly one. I mean, I think real estate's a great investment, and I've had it and done it and own it for sure. But for us too, in addition to that, we own energy, we own natural gas, we own oil, we own fertilizer, we own all the metals, a lot of the metals we own. We own um, a lot of gold and gold miners relative to what we've owned in the last 20 years. And so our percentages are fairly high in that right now. So that's where we get that exposure.
Utilities have been outperforming the S&P for the last 3 months. You did mention you like utilities as well as fertilizers. What's your thesis for both utilities and fertilizers?
Well, for fertilizer, first of all, the input to fertilizer is a commodity, and typically it's going to be nitrogen, natural gas. I mean, a lot of that fits in the input. On the output for fertilizer are obviously grains, all kind of soft commodities, but that all comes through fertilizer. So you pick it up on the other side as well. You have a bigger demand for it. When you look at it, I think that's where that's where you pick that up. I'm not certain I answered your question, but that's where I think you pick it up on that side of things. I think you asked me something else about it, something besides the
Utilities,
fertilizer.
yeah. Do you
Oh,
like
and the
utilities as
utilities.
well? Yeah.
The utilities, I think the change there is the business model is changing.
Hmm.
If you look at the amount of electricity that's going to be needed, we, we haven't owned utilities. We've owned them in the last 18 months, okay, 2 years. But before that, we hadn't owned any in a long, long time. But what's happening is you're going to have big demand for electricity, and we haven't really set up for it in this country. I mean, all of our nuclear is really old and dilapidated. They're trying to get some small nuclear going for corporations, but we haven't let them build new plants. A lot of things go on, and so they're going to be a lot of pressure on the grid. And I think utilities will be more of a growth industry going forward because all of the things that are producing now are productive. AI, data centers, any of that sort of thing, even Bitcoin miners. All of that takes a lot of energy, and you're going to have to fund it some way or another. And we think it'll be natural gas, but that's just our opinion.
Okay, so it's not really a defensive play that you're positioning yourself into something defensive. It's just you're bullish on that particular sector for those reasons you stated.
That's right. I mean, the dividends are good; they're okay,
Yeah.
but they're
Okay.
not they're not anything like we get in some of the high income items.
How do you feel about consumer staples, another sector that's been outperforming the S&P, the Walmarts and the um,
Yeah,
you
we
know,
we own consumer staples and we bought them. I mean, one of the things we started doing last year, because that group got really cheap last year, so we went in and started buying that group. And when we first started buying, people thought, well, my gosh, why would you do that? And we said, well, it on a relative basis, okay, those companies are really cheap. We didn't have a crystal ball or anything. We were just looking at the valuations and what happened on them. And so, if you look, a lot of the things we went into, they've done well, but they were kind of old state tried and true companies, really.
and gold. You have a chart showing gold versus homes. This is interesting. In 2004, um, it took 451 ounces of gold to buy a home. In 2024, I'm assuming you used, the national median home price here. It now takes only 156 ounces of gold to buy a home. I think this indicates that the price of gold has been greatly outperforming residential real estate as a national average, I think, is what you're trying to illustrate here. Is gold a better longer term hedge against inflation than, I guess, property?
Well, we don't look at it as maybe better than property or whatever. Obviously, if you have built buildings, you're in good shape. Not some development side, but on the gold side, if you look at gold, you just keep on going back. Okay, you'll see that in the long run, gold goes up in the long run. And you'll go through periods where, you'll go through 4 or 5 year periods, sometimes 6 years, where it doesn't go anywhere. In fact, it falls off some, and people lose faith in it, and it comes back and goes to new highs. But I think this time around, because of what the U.S. has done, people want to get away from the dollar, and if you're gonna own anything, you've got to own gold as a hedge against the dollar, number one. But what's going to happen because they're buying gold? They do not want, if you go look at the amount of Treasury securities they own now, it keeps going lower and lower and lower since 2013. And so you want to be side by side by those other countries that are buying gold. And I think that's where people probably make an error. They don't realize, well, they say, and all I'm saying is you need to have enough to where as prices move forward, and you have inflation, you have things turn around, gold will stay up with that over time. It may not month to month, but it'll stay up over time.
Well, commodities overall are relatively cheap, as you have a chart showing that in this next chart, commodities versus the stock market's lowest since, I believe, for a number of decades now. Ted, what does this mean from an investment standpoint?
Well, it means that with these 40 years of lower interest rates, everything became, David, financialized. In other words, everything's finance. If you look at everything that goes on, it's money. Money this, money that. And every time you had lower rates over that 40-year period, people kept financing, refinancing, you know, pushing up prices. Everything had to do though with the cost of money that was so cheap, and it got cheaper all along. Okay, the game's changing now, and so you're going the other way. And if you go back and look during say 1960, 3 or 4 up through about 1983, 82 and 83 is a very similar look we had. We had too much, we had trouble with the debt, and it went into a period where the commodities outperformed because your inflation rate was running so high that financial assets weren't doing the trick for you. You had to have something else to add in with them.
Financial assets now. Let's move on to financial assets. So yields going down. The Fed and other central banks are cutting their rates. What does this mean for fixed income?
Well, if somebody wants to take the bet, okay, that they're going to take, which I would call it a bet, that they're going to take the rates back from, say, a 5% Fed funds rate to say 2.5. And they may, I don't know. But if they did, and you own the long bond, for example, yeah, you'll make some money on it one time. If you own the 20 and 30-year bond. And if you own the short bond, we own a lot of short paper, but we own paper 2 and 3 years as well. But on the short paper, you get affected because instead of getting 5, I'll be getting 2.5 or 2 3/4. I just don't think you're going back to that period before where it was a quarter of a point. I think I think that will be the difference this time around, because as soon as those rates get down in that lower trough, people will start spending again. They'll start leveraging again, and you'll do this whole trade over again. But it won't be 9% the next time. It'll be more like 11 or something. It'll be some number that'll be a negative number. We just have too much debt. If you look at total U.S. debt, including the government, $100 trillion.
Wait, $100 trillion of
And
U.S. debt.
total U.S. debt. That's in government and private, everything.
Okay. I understand. Now, Ted, what about the yield curve? It's been steepening. Do you expect that to continue?
David, it's a weird yield curve. If you looked at it, it's high, it goes down, and it comes back up on the other end. And what's happening is people haven't really made any money on, say, 5 to 15. They haven't made any money because that moved a little bit, but not a lot. And then on the long end, the 20 and 30 year, yeah, they've moved some from where they were a year ago, um, but not enough right now to say I've made a lot of money doing that. And that's caused us, we mentioned in our 30-30-30-10 that on the bonds you have to trade them, and we did. We bought some 20 and 30-year paper, some 3-4 months ago when they first started lowering, just on a trade, and we traded it. We're not even in it now. We made a little money on it, and we're back in the short paper now. But I think the curve, the way it is right now, you have to be careful because it's not, when they talk about a steepening curve, it's high at the front, goes down in the middle, and it goes back up at the end. And you're not getting paid much to really, we don't think, to take the risk of owning that 20 and 30-year paper.
So you would be positioned more for the short end.
We are, yeah. We're basically have a lot of money in the 3 to 6 months. We have a lot of floating rates at the 3 months, and then we have a lot at 1 year and year and a half. We were at 2 year, but we moved past that, so we're 6 months into it. But so it's about 18 months now.
Do you like corporate bonds now that the Fed has cut rates and
We we own some, but we own them 5 years and less on the corporate side. They'll pay a little more than the Treasury. It has to really be a good credit for us before we'll buy them. And we don't near as much of that. We only own maybe 10% of corporate versus what we would own in the Treasury.
oil? It's not a financial asset, it's more of a commodity, but we'll talk about oil now. You said you own oil. Do you own oil stocks or just futures and oil?
Oh, we own the stocks, and we own
Okay.
uh, not only own the producers, but we own the pipelines. We don't own a lot of the service companies, which you could, but we own the producers, and we own the pipelines, and that's really how we participate in all of that. and natural gas too.
And by the way, Exxon, for example, has outperformed the WTI price year to date. Is there a particular reason why the stock is doing better than the commodity itself?
Well, I think the biggest reason, David, is because it's the main stock. You take the XL, all the you go the ETFs that have energy.
Hmm.
Okay, Exxon's the biggest holding, and in some of them
Hmm.
it's a really large holding, larger than it probably should be, but it's really liquid, so that's why they put it in there. So it gets the buying from that.
I see.
When I don't think, and we own Exxon, don't get me wrong, but we own a lot of others too, and we own Conoco, we own a number of them, EOG, in Northern Oil and Gas. There's a lot of things we own, but that's why you get that one. It's the biggest. That's where the liquidity is, and I think that's where they're going with it. And one of the things you have to keep in mind, we have no idea what will happen in the Mideast with those two situations,
Right.
but either one of those could cause you to be in a situation where oil gets in a situation where it's really in big demand, but there's no supply, particularly, and we'll have a lot more supply, but it would push the price. And I think it does okay either way, but that's just something that you have to be on the lookout for because if that happened, you need to have some oil.
The oil price has, if you just look past the past 20 years, post 9/11, following the invasion of Afghanistan and Iraq, oil has continuously gone up until 2008. I'm not sure if that was due to just the Middle East or were there other factors involved. What would you say were the main drivers of the much higher oil
Well,
price over the last 20 years?
well, one of the drivers to bring it off was we got up to $120. And I remember back, over the years when it's up high, you always have the people that think, hey, it's going to 200, 250. It never does. It's always at the top. And unfortunately for oil and gas producers, they're not good themselves at knowing when to cut back and when to add on. When things are really hot in the oil market, they just bring more on, you know, and they sort of kill their own supply. In other words, they bring their supply too much. And when things are really low, when they should be really getting aggressive to buy oil and do a lot of things, they pull the horns in. But over this period of time right here, it's just, the demand's been good. Worldwide demand's been okay. And, we've been able to produce a lot more in this country as well. So I feel good about this country for sure.
Okay. So final question on this general uncertainty and volatility. I've heard some comments about this into the election, which is that post-election we'll immediately get some sort of rally just on the certainty of knowing what the government is going to look like for the next 4 years. Do you agree with that idea?
David, I don't know. I mean, we sort of, we buy the companies we like and we buy the we like, but I want to answer it this way, and that is, uh, if that's what they're banking on, then that wouldn't be a policy we would do. But I will tell you this: I can give you the facts on this. The first year of a new presidential 4-year term is the worst one, and that's for sure. And it's always been that way. And I think people that don't realize that no matter who comes in, the first year is a hard year in the markets that they are. And we'll see if that does it this time, but that's usually what happens.
Well, I think one thing that we should note is that neither party has, well, it's projected that neither party will cut spending significantly, such that the deficit will be reduced. And in fact, there's been a number of studies. Penn Wharton, for example, has done the study that show that the deficit will increase or widen under either administration. What does that mean for markets, you think?
Well, I think that's where people get confused. They think, one or the other is a panacea. When if you look at the policies, they both want to spend a lot more money, cut a lot of things, do a lot of giveaways, either through tax reduction or all these other policies that want to give away things. But when you give away things, you cut the revenue. And when you cut the revenue, that means you got to run a bigger deficit. And you will get to a point. I don't know when that is, but you will get to a point someday where the countries say, we're not buying your bonds. You're already buying less, but we're not going to buy any, because you've just run yourself into a hole here. And that might not be for 5, 10 years. I don't know. But I know every little bit of that hurts you as a country eventually. And that I think for us to not realize that. When's the last time you heard either one of these parties talk about let's balance the budget? You you tell me. I mean, it's been so long, it's incredible, and all the congressmen they do the same thing.
In that scenario, at some point in the future where we have a failed bond auction, what happens to financial assets?
Well, if you get into a situation where they can't sell the bonds, that means they've got to raise the rates to sell the bonds. And if they raise the rates to sell the bonds, that means they're going to have to print more money. And that's the way that game goes. And I don't see them defaulting or anything like that, but I do see them having to push out a lot more money, which means inflation eventually, because they would have to raise rates in order to sell the paper if they couldn't get a buyer. That's what that's all about.
So bottom line, are you changing your positioning into Q4 much from the prior quarters this year?
Not really. We just look at the companies we want to own, and if they're right, regardless of where we were, our first quarter next year, we would still buy them. I will tell you the markets are, there's two things I would mention to you. Number one, the markets are extremely overpriced for us. And by that, I mean, if you look at the current multiple of 27 times, but the future multiple of 22 times on the S&P, I mean, if you look at that, that means people are not thinking about anything they're buying. That means they're just pushing it into the market, not worried about a thing. That's one thing. The second thing, and I think this is one of the biggest problems, is the complacency level today is as high as I've ever seen it. And I've been around as longer than most people in the business right now. And I've never seen the complacency level, even 2000. 2000, there were two groups. You had a lot of people that were complacent because they were buying the hot stocks of the internet, but you had another group over here that were really worried about the whole thing. Now you don't have any of that. Everybody is in, and it's going higher and higher and higher. And if you look at, like I mentioned before, the people in their 60s and 70s and 80s, they have too much exposure to equity. You could cause some real problems just in society by things like that because they've got risk assets and they're not playing it like it's a risk asset.
Well, okay, let's end on this. So the sentiment in the stock markets right now, despite the fact that valuations are very high, like you said, is it one of buying? Is it holding? Or people starting to sell? What's more dominant right now based on your observation?
Well, my observation on the sentiment is I'm not worried about it. Put more money in. I'm not necessarily, don't worry about putting more money in because it's done well and I'm sure it'll do well in the future. And look, I got to buy the index and buy the ETFs and hey, we're ready to go here. So let's just keep on piling on. If you go out and I go all across the country and look at who's spending the money, it's the boomers. I mean, they're out here spending in the parks and the hotels and overseas. And they got their 401ks high and their stock portfolios are high. Their home prices are high. And they're like, hey, we're pretty rich right now. Let's just go spend some of it. And so that's why any break in that would have a big impact.
Okay, very good. Thank you very much for your update today, Ted. Where can we learn more from you and Oxbow Advisors?
Well, you bet, David. I'm always happy to visit with you because I tell you, you've been super successful in your program. I've watched you over the years.
Appreciate it. Thank you. But Oxbow Advisors, is there anywhere else we can follow you and your work?
Yeah, the best place, David, is just come to the website, oxbowadvisors.com. We're really very transparent. We don't try to hide things from anybody. We're much like, I guess, Warren Buffett is. You know everything the people own. And you'll see what we do, and we don't. We really feel like that there's no holy grail. You just got to do the best you can and try to buy the best you can because that's where you make the money on the buy side.
Thanks very much, Ted. We'll look forward to having you back again and more volatility for sure for Q4. So looking forward to next time. And thank you for watching. Don't forget to like and follow Oxbow Advisors down below.